Due to the economic growth in the United States and the implementations of both fiscal and monetary policy over the year, but more importantly, the recent volatility in the stock market for the first quarter of 2018 has caused many people to speculate whether or not we are finally at the peak of the business cycle. The real estate market almost mirrors the economy, so if the economy is healthy, the real estate market should be healthy, and vice versa. The business cycle are periods of economic growth and contraction, so this is a vital factor to make informed decisions to determine whether you'll get top dollar at selling a house or get the best deal on buying a house. Therefore, following a decade since the Great Recession, my advice is to take advantage of the market right now by selling, because right now the inventory is extremely low and housing prices are high. It's also a good time to buy right now because mortgage interest rates are still historically low. Mortgage rates have always fluctuated, and they have been much higher than where they are now. This is why rates are going to go up over time. I recommend you lock a rate sooner than later. Since higher mortgage rates make it more expensive for house buyers to purchase a home, it can diminish a buyer's purchasing power, which can lead house prices to fall. Luckily though, house prices should continue going up, but much more modestly now than it has in the past 5 years. According to the NARD chief economist, house price gains will soften. Based on the S&P Home Price Index, U.S. house prices are 6.3% above the peak reached in the housing bubble in 2006. There has been a lot of noise in the news lately because the Federal Reserve has been tightening the money supply since 2015. And they've been doing this by raising the federal fund interest rates. And the reason why this has caused some people to worry is because it makes it more expensive to acquire a loan. However, federal fund rates are short-term rates. Mortgage rates are generally driven by long-term rates. Therefore, it is the 10-year Treasury note yield that has a direct relationship on mortgage interest rates. This is because the yield has a high influences on borrowing costs for individuals and corporations. So yield and mortgages move in the same direction. So when the yield rises, mortgage rates rise, and vice versa. A weak or strong stock market can dictate where mortgage rates will go based on how the U.S. Treasury bonds and notes are affected. U.S. Treasury notes and bonds are safe havens for investors when they see a weak stock market. The U.S. Treasury note and the yield have an inverse effect on one another. For example, when the stock market is rallying, the demand for U.S. Treasury bonds fall, which causes Treasury bond yields to move higher. The opposite usually occurs when the stock market is falling. So my best advice is, once you're ready to step into the real estate market, hire a professional real estate agent that can take care of your needs and also understands where we are in the economy. I've chosen this career because it really ties into the American dream, and if I can help people attain that goal, then I'm happy. And truthfully, I'm hoping you'll call me. And on that note, happy buying and selling.